Today is Tuesday, April the 7th, and there are some strange things to take a look at today. The sharp pullback was not totally unexpected for a couple of reasons. Number one, the coronavirus thing isn't going away. Just because we have one day of lower deaths in a time where we're expecting 2 weeks of lots of deaths, this was predictable. But still some funny things to happen. Where did we finish off? We finished off with the Dow just a little bit below yesterday's closing, same with the NASDAQ and same with the S&P 500. So what it means that all day we lost all of our gains, but advancers still led decliners because by the end of the day there were still a lot of stocks in a ratio of almost 2 to 1 that ended up advancing. On the stock exchange basis, so on the NYSE basis, that means that our McClellan oscillator was positive and moved up above the oversold line again. Now, what's significant here is that it's higher than this point. If we had had a downturn, we would have had 1, 2, 3 lower highs showing us, like in here, that and in here, or here, here, and here, that over this period of time, the bears were keeping a damper on money moving into the market. But it's above the overbought line, so we can expect to see a bit of a pullback. And in a strong market, we can expect to see lots of days where we traverse over and below this line right here. So that's what we're going to look for. And that is going to be indicative of, which I've been showing for a while, the type of motion that we saw in 2009 after the market was recovering from its financial losses of 2000, 2007, 2008. So we're going to see lots of volatility all around the overbought line, and that'll be confirmation that we're moving back up. Our up and down volume still showed significant up volume, less than yesterday, and our down volume was about 4 times as great as yesterday. So it's a day of, mixed signals, but we still see some pretty interesting things in our charts, so that when we look at the S&P, our Gartley here, which is actually a BAT, B-A-T, form of a Gartley pattern, is still intact. And what we saw is a move up, and we finished the day off, as the charts are showing you before, with all of our gains having been lost. We opened up here, popped up, and finished all the way down at the 38.2% and still maintained 38.2% Fibonacci support. The volatility index moved up a little bit, 0.16%, bouncing again off the 50-day simple moving average. Apple is interesting. Apple got rejection at the 50%. Now, its little Gartley bat pattern is playing out to 278.30, so that's still intact, but which would be a Fibonacci golden ratio move above B and C. So 1.618 above B and C would be this point right here. First stop in the Gartley, second stop in the Gartley would be down here. And then there's a third one eventually that we could see at 1.13 of the X to A move. So that's still intact, but you can see that Apple also lost all of its gains and was really cruising to a nice profitable day, and that got wiped out. Rejection at the 50%. So what I said to, I think, Andy today in one of the comments is that, I expect the moves to be up to 50%. So for the S&P, that would be up to 2793. For Apple, it would be up to 270, and that's what we saw today. And it's like being on a tightrope walker between 2 big buildings or over a giant gorge. He sort of stops in the middle, looks forward and looks back, but there's support behind him because there's the people that he left behind him, and he wants to make sure that they're still there. So he turns around and he goes back. And I think that that's still what we could see, except we may not now see this 213 test in Apple. We may instead see a 243 or a 240 support in Apple if we're going to have any type of a V-shaped or W-shaped bottom. For for the S&P, it would look much the same. It may not be down at the 2200. The new test of the bottom may be at 2470. Caterpillar still had a good day, up 0.9%, but you can see that this trend line that we drew long time ago, which covers January of 2018 and several touches in the late fall of 2018, and then another touch in July of 19, and then a bounce back in support of February 220, we've seen it act as resistance now. So we've got another factor in play in Caterpillar, and that's this trend line. So technical traders are positioning themselves to be selling, first of all, at the 200. So we had people selling just in front of the 200, but they were surely selling at the 38.2% Fibonacci. And then we managed to move back and catch a bounce in the day off the 50 simple moving average, this dashed line here. So the 38.2, the 200, the trend line, the 50, all of these things coming into play all in one day. Disney only up 18 cents today. Home Depot looked like it was really on fire. It was up to over 200 at one point, 204. Its Gartley pattern, which has a target at 213, is still in play. But it, like everything else, the market took some of the gains back from it today. AT&T finished up 2.45%. It's the dividend that's in play here. U.S. Bank was doing not too badly. It's paying its full dividend on April the 15th, the same time that AT&T is paying. And Whirlpool finished up 242 with a doji, so indecision right in the middle. So that sort of summarizes what I wanted to say about our major stocks. I do believe, though, that the premise that Jamie Dimon said that we are in for a recession, and yet Citibank or some other analyst was saying we've seen the bottom. So who do you believe? Jamie Morgan has a lot of people that follow his advice. And I am still looking for a test somewhere, and that test may now come at the most recent low. So if we have strength and if it's going to come back, the bull market is going to come back, what we need to see in all of these charts is a higher low. We cannot go below the C pattern in these Gartleys. First of all, we negate the Gartley, it's gone, and then it shows a tremendous lack of technical support or support by the technicals and the technical traders. And it's just a sign that once we've lost the C portion, there's a pretty good likelihood that we're going down even further and forming that W-shaped technical trading pattern that we've been calling for.